Hello and welcome back to the Deep Dive. Today we are walking into the lion's den. We are tackling a concept that, let's be honest, sends a cold shiver down the spine of almost anyone who isn't a seasoned Wall Street veteran.
Or a math genius.
Or a math genius, exactly. We are talking about the D word, derivatives.
It is arguably the most intimidating word in the entire financial lexicon. It's often painted as this complex, dangerous, sort of black box instrument.
Right.
You might remember Warren Buffett famously calling them financial weapons of mass destruction. That quote has hung over the industry for years.
Which is exactly what you want to hear right before you start studying for a certification exam. Here, hold this weapon of mass destruction.
Right. It does set a certain tone. But here is the reality check for our listeners today, specifically those of you preparing for the NISM Series-X-A certification, the Investment Advisor Level 1 exam.
The big one.
It is. And for that exam, fear is simply not an option. You cannot skip this chapter. You cannot just skim it and hope for the best.
Because this is Chapter 10 of the study material, Understanding Derivatives. And from what I hear, this chapter is a heavy hitter on the exam. It's not just a footnote, is it?
It is absolutely critical. It's a foundational chapter. I mean, if you don't really get this, you will struggle with risk management, you'll struggle with portfolio construction concepts later on, and you will definitely struggle with the exam questions.
Okay, so the stakes are high.
Very. And my mission for this deep dive is actually very specific. I want to demystify Chapter 10 so thoroughly that by the time you finish listening to this, you could essentially walk into that exam center and pass the derivatives section without ever opening the PDF again.
That is a massive promise. I mean, we're talking about legal acts, math formulas, some pretty abstract concepts here.
I intend to keep it. We are going to break down every single definition, every legal act, and every mathematical example that's provided in the text. We're just going to read the definitions. We're going to take them apart, see how the engine works.
Look at the nuts and bolts.
Exactly.
Okay, I'm ready. I'll play the role of the student here. I'm going to be the proxy for you, the listener. I'm going to ask the stupid questions, the ones everyone is thinking but might be afraid to ask.
There are no stupid questions.
And I'm going to push back when things get too abstract. I'm counting on you to be the mentor, and I need you to specifically flag the stuff that is going to show up as a multiple choice question.
Deal. I will explicitly say, flag this for the exam when we hit those potential questions. We'll build a sort of mental highlighter as we go through it.
Perfect. So let's start at the very beginning. Section 10.1, Basics of Derivatives. What actually is a derivative? Because the name itself implies it comes from somewhere else. It feels, I don't know, secondary.
You have the core definition right there. You've already nailed the intuition. A derivative is a contract or a product whose value is derived from the value of some other asset.
Okay.
And that other asset is technically known as the underlying.
The underlying. Okay, so
Yeah.
the derivative has no independent soul. It has no value of its own. It's just a shadow of the thing standing behind it.
That is a fantastic analogy. It's a shadow. Think about it. A shadow cannot move unless the person casting it moves.
Right.
If the object moves, the shadow moves. If the underlying asset's price changes, the derivative's value changes. You cannot trade the shadow without referencing the object. The derivative is intrinsically, fundamentally linked to that underlying asset.
So what can be an underlying? Are we just talking about stocks here? Because I hear about derivative markets, and my mind just immediately goes to people betting on Apple or Reliance.
And that's the most common one we see in the news, for sure.
Yeah.
But the text is very specific here, and you need to know these categories because the exam might ask you to identify an invalid underlying, though in theory, almost anything with a fluctuating price can be one.
So what are the official categories in the textbook?
The text lists 4 distinct categories of underlying assets. First, you have metals. This is the classic commodity trade. Think precious metals like gold and silver, but also industrial metals like copper or aluminum.
Okay, so hard assets, things you can actually hold in your hand. Yeah.
Exactly. Second, energy resources. This is huge for the global economy. Crude oil, coal, natural gas. The price you pay for petrol is heavily influenced by the derivatives market on crude oil.
Right. Airlines use these to hedge their fuel costs, that kind of thing.
Precisely. Third, agri-commodities. This is actually where derivatives started, historically speaking. Farmers hedging their crops. We're talking about wheat, coffee, sugar, cotton.
So physical stuff we eat and use every day.
And then fourth, the one you mentioned, financial assets. This is where we see shares and bonds. So whether it's a bushel of wheat, a barrel of oil, or a share of Tata Motors, if you build a contract based on its changing price, You have yourself a derivative.
Oh, okay. That makes sense conceptually. It's like a wrapper around an asset's price.
Yeah.
But since this is a certification exam, I assume there's a really boring legal definition we need to
Oh,
memorize.
absolutely.
The regulators usually have their own way of saying things that is 10 times more complicated than it needs to be.
They certainly do. And there are actually two legal definitions you need to know, and they come from two different acts. This is our first flag for the exam moment.
Okay.
The examiners love to mix these up to trick you. They might quote the RBI Act and ask if it's from the SCRA. It's a common trap.
Okay, I've got my mental highlighter out. What's the first one?
The first definition comes from the Securities Contracts Regulation Act, 1956. We usually just call it SCRA.
SCRA 1956. Got it. What do
Right.
they say?
Okay, so under this act, a derivative is defined to include two specific things. You need to know both parts of this.
Okay, part one.
Number one, a security derived from a debt instrument, share, loan, whether secured or unsecured, risk instrument or contract for differences, or any other form of security.
Whoa. That is a mouthful of legalese. A security derived from a security. It sounds recursive.
It is, essentially. It's designed to cover the entire financial side of things, debt, shares, loans. It's trying to be all-encompassing when it comes to financial paper. But then there is number two,
And what's part two?
a contract which derives its value from the prices, or index of prices, of underlying securities.
Index of prices. So we are talking about things like the Nifty or the Sensex.
Exactly. You can't just go and buy the Nifty. It's not a thing you can own.
Right, it's just a number.
It's just a number. You could buy all 50 stocks in the Nifty individually, but you can't go to the store and buy one unit of index. However, you can buy a derivative based on the index. So if you trade a Nifty futures contract, it falls under this specific definition in the SCRA because its value is derived from an index of prices.
And what's the big deal about it falling under this act? Why does it matter which act it's under?
The implication is jurisdiction and legitimacy. It means that derivative trading is legally considered a security, and therefore it is governed by the regulatory framework under the SCRA. It brings it squarely under SEBI's control.
I see. It legitimizes it as a tradable security, not just some back alley gambling contract.
You've got it. That's the key implication.
Okay, so that's the security side of things. You mentioned a second act.
Yes. And this is often the curveball on exams. The term derivative is also defined in the RBI Act of 1934. Specifically, you need to remember Section 45 UA.
Section 45 UA, that sounds incredibly specific. Why does the RBI care about derivatives? I thought they just printed money and yelled at banks about interest rates.
Well, they do a bit more than that. The RBI manages the country's monetary policy, interest rates, and, crucially, foreign exchange. So their definition focuses on those aspects.
Okay, so it's a different angle.
A very different angle. Let me read the breakdown of Section 45 UA because the wording really matters here. It defines a derivative as an instrument to be settled at a future date. That phrase is key, whose value is derived from a change in interest rate, foreign exchange rate, credit rating or credit index, price of securities, or a combination of them.
Okay, I noticed something there, credit rating. That wasn't in the SCRA definition.
It's a sharp catch.
Yep.
Yes, this definition is broader in terms of the macroeconomy. It brings in things like credit ratings and forex rates. It's looking at the big picture variables that the RBI manages.
Does the act list any specific examples? Usually these acts have a little list of what's included.
It does, and you should definitely memorize this list because all of the following are derivatives under the RBI Act exemptee. It's a classic exam question format.
Okay, let's hear the list.
The list includes interest rate swaps, forward rate agreements, foreign currency swaps, foreign currency rupee swaps, and foreign currency options.
That is a lot of swaps.
It is. So if you see a question on the exam asking about foreign currency rupee swaps and which act defines them, your brain should immediately go to RBI Act 1934, Section 45 UA.
Got it. So a simple way to remember it might be RBI equals currency, rates, and swaps, and SCRA equals stocks, debt, and indices.
You nailed it. That simple distinction will absolutely save you a point on the exam.
All right, let's move to Section 10.2. Underlying concepts in derivatives. There's a phrase I hear constantly, in movies and from cynical traders. The stock market is a zero-sum game. Now, I know that's not strictly true for buying and holding stocks because a company can grow, create profits, and, well, everyone can win.
Right, the pie gets bigger.
Exactly. But for derivatives, the text says it is a zero-sum game. Why is that?
This is a fundamental concept that trips people up. In the spot market, when you're buying a share of Infosys, you own a piece of a real company. If Infosys creates value, wealth is created. The overall pie grows.
Okay.
In a derivative contract, you don't own the asset. You have a contract against another person.
It's a bet. Let's just call a spade here.
Effectively, yes. It's a structured bet on the future price. Let's look at the gold futures example from the text to really visualize this. Imagine we enter a contract. You are the buyer of gold futures, and I am the seller.
Okay.
You think gold prices are going to rise? I think gold prices are going to fall.
Right. We have opposing views. We can't both be right. One of us is going to be wrong.
Precisely. Now, on maturity, let's say the price of gold has gone up by, say, 100 rupees. You make a profit of 100 rupees. Where does that money come from? It doesn't come from a gold mine. It doesn't come from the government printing it.
It has to come from your pocket because you bet against me.
Exactly. My loss is your gain. I lose 100, you gain 100. And if gold goes down by 100, I make a profit, and that money comes directly from your account.
So when you net our two positions, my plus 100 and your minus 100, it adds up to 0.
Always. It always amounts to 0. Wealth isn't created. It's just transferred from the person who is wrong to the person who is right.
It's a wealth transfer mechanism, not a wealth creation mechanism.
That's the perfect textbook definition. Now, the text does add a small but important caveat. This calculation assumes no transaction costs or taxes. In the real world, if we both pay a broker fee, the net result for us combined is slightly negative. But purely mathematically, between our two positions, it's zero sum.
Got it. Now, you mentioned maturity earlier. How do we actually settle these things? Do I have to show up with a truck to collect the gold? Or if I buy a derivative on 1,000 barrels of oil, do I need a swimming pool to store it?
That brings us to the settlement mechanism. And for a very long time, most derivative contracts were cash settled.
Meaning what, exactly?
Meaning, if you won 500 rupees and I lost 500 rupees, my broker just transfers 500 from my account to yours. We don't exchange the actual gold or the actual shares. We just exchange the price differential, the profit and loss.
That seems much, much easier.
It is. It's clean, it's fast, and no trucks are required.
So why would we ever do it any other way?
Well, this is where you need to get your highlighter out again. This is a massive exam flag. SEBI has changed the game for stock derivatives in India.
Oh. What did they do?
SEBI has mandated physical settlement for all stock derivatives. The text says, and I'm quoting the sentiment here, that stock derivatives which were cash settled shall move compulsorily to physical settlement in a phased manner.
Whoa! Wait a minute. So if I hold a futures contract to buy Reliance shares until it expires and I don't close it out before the expiry bell rings, I actually have to buy the shares.
Yes. You will have to pay the full value of the contract and take delivery of the underlying stock right into your demat account.
That is a huge difference. In cash settlement, I just needed enough money in my account to cover the potential loss.
Right.
In physical settlement, I need enough money to buy the entire lot of shares. We could be talking about lakhs of rupees.
Exactly. This raises the capital requirement significantly if you want to hold to expiry. It stops people from speculating wildly on expiry day without having the capacity to actually own the stock.
Huh.
So you must remember this for the exam. Stock derivatives in India have a physical settlement mandate.
That definitely raises the stakes. Speaking of stakes and money, let's talk about margins. I know a margin is basically a deposit, but how does the text define it?
Margin is defined as the funds or securities which must be deposited by clearing members as collateral before executing a trade.
Before. So I can't trade on a promise. I can't just say, I'm good for it, I'll pay you if I lose.
No, you need skin in the game immediately. This is what protects the entire system. It ensures that if you lose money, the exchange knows the money is already there to cover it. It protects this system from default.
Okay, and the text talks about initial margin.
Yes, that's what you pay to enter the trade. And it has two components you absolutely need to know for the exam.
Break them down for me.
First is SPAN. SPAN stands for Standard Portfolio Analysis of Risk.
That sounds like a very fancy calculator.
It is. It's a very sophisticated piece of software used by exchanges all over the world. It analyzes your entire portfolio and calculates the likely risk based on historical volatility. It looks at how much the stock usually moves in a day.
Okay, so that's the main component. What's the other one?
Regulators add a second layer on top of that called ELM,
ELM.
extreme loss margin. This is an extra buffer for those black swan type events, situations where the market crashes way more than the normal SPAN model predicts. It covers the tail risk, the really unlikely but catastrophic moves.
So initial margin equals SPAN plus ELM.
Correct. And conceptually, the text wants you to visualize the math behind this. The total initial margin should be large enough to cover the potential loss in 99% of cases.
99%. That's a high level of confidence.
It is. It means that on 99 days out of 100, the margin you posted is enough to cover your maximum expected daily loss. And there's a direct correlation you must understand from this.
Which is?
The greater the volatility of the stock, the greater the perceived risk. Therefore, the greater the initial margin required by the exchange.
So a boring, stable utility stock that barely moves will have lower margins than a wild, volatile tech stock.
Exactly. The exchange demands a much bigger buffer from you if you want to trade the wild ride.
That makes perfect sense. Is that the only margin we need to worry about?
For futures, mostly yes. But for options, there is something called premium margin.
Okay, what's that?
This is specifically for the buyer of an option. The buyer has to pay the premium value multiplied by the quantity of options purchased. It's the cost of buying the right. You pay this upfront, in full, in cash. It's not a deposit you get back. It's the price tag for the option itself.
Okay. Moving on to another term that always confuses people. Open interest. I see this on the news tickers right next to volume. How is open interest different from just trading volume? They sound similar.
They do, but they measure two completely different things. This is a classic exam question. Volume is simply how many contracts were traded today. It's a counter. One buy plus one sell equals a volume count of 1. And at the end of the day, it resets to 0 for the next day.
It's a flow.
It's a flow. Open interest OI is different. OI is a stock. It's the total number of outstanding derivative contracts that have not been settled or closed out yet. It accumulates.
Can you give me an analogy for that?
Think of a nightclub. Volume is the number of people walking through the door, both entering and leaving. The bouncer has a clicker. Click, click, click. That's volume.
Okay.
Open interest is the number of people currently inside the club on the dance floor at any given moment.
Oh, I like that. So if 100 people enter and 100 people leave, the volume is 200, but the open interest could be 0 because the room is empty again.
You've got it perfectly. And the text explains the flow of money using OI. This is crucial for interpreting market sentiment. OI only increases when a new buyer and a new seller come together to create a new contract.
So two people walking into the club who weren't there before.
Yes. If an existing buyer sells their contract to an existing seller who is closing out their position, it's like two people inside the club just swapping partners and then leaving. The contract disappears and OI decreases.
So what does rising or falling OI tell a trader?
Increasing OI indicates that new money is flowing into the market. The party is getting more crowded. It suggests conviction behind the current trend. Decreasing OI means money is flowing out, positions are being closed, the party is winding down, and the trend might be losing steam.
Very clear. Okay, we've got the basics and the underlying concepts. Now let's get into the meat of the chapter, section 10.3, types of derivative products. The text calls out the big four.
Yes, you have to know these inside and out. Forwards, futures, options, and swaps.
Let's start with 10.3.1, forwards, the granddaddy of them all, right?
That's right. A forward contract is the simplest form. It is a bilateral agreement, meaning just between two parties, to buy or sell an asset at a specific future date at a price that you decide today.
The text has a specific example about a goldsmith. I find stories and examples really help these abstract ideas stick. Can you walk us through that goldsmith scenario?
Absolutely. The scenario set on March 9, 2018. You, the listener, want to purchase some gold.
Okay.
First, let's look at the spot market. This is the normal way of buying things. You walk into the jewelry shop, you pay the price on the board, which is RS, $30,425 for 10 grams, and the goldsmith gives you the gold immediately. Transaction done. You walk out with the gold in your pocket.
Simple. Cash for gold.
Now the forward market. You talk to the same goldsmith, but you want to buy the gold in a month. He quotes you a price of RS, $30,450 for delivery after 1 month. You agree? Maybe because you think the price might jump to $31,000 next month, so locking in $30,450 sounds like a good deal.
So we shake on it.
You shake on it, you sign a piece of paper. Here is the key. No money or gold changes hands on March 9th. It's just a promise.
Okay, so I'm locked in at that price, RS, $30,450.
Correct. Now, fast forward 1 month. You must pay ORS $30,450, and he must give you the gold. It doesn't matter if the market price of gold has crashed to ERS 20,000. You are obligated to buy at $30,450. You'll hate it, but you have to do it.
And on the flip side, if the price goes to $40,000, he has to sell it to me at $30,450. He will hate it, but he has to do it.
Exactly. You both froze the price, for better or for worse.
What are the main characteristics of this forward deal?
First, as we said, it's bilateral and over-the-counter, OTC. It's not on an exchange like the NSE. It's just a private deal between you and the goldsmith. Second, it's completely customized. You decided the exact quantity, 10 grams, maybe a specific quality of gold, and the exact date. You negotiated all the terms face-to-face.
But there have to be downsides, right? This sounds too simple. Why don't we just use these all the time?
The text highlights two major limitations. Number one, liquidity risk. Because these contracts are tailor-made just for you, you can't easily exit.
What do you mean?
If you change your mind a week later, you can't just sell your contract to someone else easily. Who else wants exactly 10 grams of that specific purity on that specific date with that specific goldsmith? You're stuck. You can only get out if the goldsmith agrees to cancel the deal.
And the second limitation.
This is the scary one. Counterparty risk. It's the risk that the other person in the deal will just not show up, the risk of default.
Can you give me an example of that?
The text uses a great example with rice. Let's say person A agrees to buy rice from person B in 6 months at Rs 20 kilograms.
Okay.
Now imagine in 6 months, there's a drought, and the market price of rice shoots up to Rs 30 kilograms. Person B, the seller, is supposed to sell it to you for 20, but he can sell it in the open market for 30.
So he has a massive financial incentive to just ghost me.
Yeah.
To disappear and sell it to someone else.
Exactly. He might default to sell elsewhere for a higher profit. Conversely, if the price drops to Rs 15, person A, the buyer, might default because they can just buy it cheaper in the market. Without an exchange in the middle, you are relying entirely on the other person's honor.
And in finance, relying on honor is a risky strategy.
A very risky strategy.
I assume this is why futures were invented, to fix this trust issue.
Precisely. This leads us right into 10.3.2. Futures. Futures markets were innovated specifically to solve the limitations of forwards. A future is essentially the same agreement. Buy or sell an asset at a future date at an agreed price, but with one massive difference. It is made through an organized exchange.
So the exchange is the middleman.
It's more than a middleman. The exchange, through its clearinghouse, becomes the counterparty to both the buyer and the seller.
What does that mean in practice?
When you buy a future, you aren't buying it from Bob the investor. You are buying it from the National Stock Exchange. And Bob, who is selling it to the National Stock Exchange. The exchange stands between you.
So the exchange guarantees the trade will happen.
Yes. This completely eliminates counterparty risk. You don't need to trust Bob, you just need to trust the exchange. And the exchange trusts nobody, which is why they take margins from everyone.
Okay, the text lists out a bunch of features of futures. Let's just run down that list so we make sure we catch them all.
Good idea. 1. The contract is made through an exchange. 2. It's a centralized trading platform, open to all. 3. You get price discovery through the free interaction of thousands of buyers and sellers. It's a transparent auction. 4. Margins are payable by both parties to protect the exchange. 5. The quality of the asset is standardized. 6. The quantity or lot size is also standardized.
Standardized seems to be the key difference from the customized forward contract.
Yes, absolutely. You can't call up the NSE and ask for a futures contract on 12.5 shares of Reliance. You have to buy the lot size defined by the exchange. It's a take it or leave it kind of deal, but that's what makes it liquid.
The text also mentions figurative buying and selling. What does that mean?
It's a good point of clarification. It means that when you buy a future, you aren't paying the full price for the asset like you would at a store. You are taking on a long position. You just pay the margin. The words buy and sell in the futures world just denote your view, whether you profit from the price going up, buy long, or down, sell short.
Okay, that covers futures. Now, the third product, and probably the most popular one these days, especially with retail traders, options, section 10.3.3.
An option is fundamentally distinct from forwards and futures because it gives the holder the right, but not the obligation, to buy or sell.
That's the magic phrase, right versus obligation. In forwards and futures, I must fulfill the contract at the end. With an option, I can choose not to. I can just walk away.
Correct. The best analogy is insurance. You buy car insurance. If you get into a crash, you exercise your right to file a claim. If you don't crash, you don't call the insurance company and say, hey, can I file a claim anyway? You just let the policy expire worthless.
And for this privilege of having a choice, you have to pay a price.
Exactly. That price is called the premium.
And we have two basic types, call and put.
Very simple definitions you must know. A call option gives you the right to buy. A good way to remember it is you are calling the asset to you. A put option gives you the right to sell. You are putting the asset onto someone else.
The text then goes into this concept of moneyness. In the money, at the money, out of the money. This is where a lot of people get confused. Can we visualize this with a call option example?
Let's do it. So you have a call option, which is the right to buy. Let's say the strike price, that's the price agreed upon in the contract, is RS100. Now, if the market price of the asset goes up to RS120,
Okay.
you have the right to buy at 100, and you can immediately turn around and sell it in the market for 120. You can make an instant profit of RS20.
So the option has real, tangible value.
Yes. In this situation, the option is called in the money, ITM. It has what we call intrinsic value. Now, imagine the strike price is 100, and the market price is also 100. There's no profit to be made, but you're not losing either. This is at the money, ATM.
Okay, that's the break-even point.
Right. Finally, imagine the strike price is 100, but the market price crashes to RS80. Would you use your right to buy at 100 when you can simply go to the market and buy it for 80?
No, of course not. That would be stupid. I'd lose 20 rupees on the spot.
Exactly. So you don't exercise the option, you let it expire, you throw it in the trash. This option is out of the money, OTM. There is no gain to be had from exercising it.
So OTM options are worthless.
They have no intrinsic value, that's true. But they might still cost money to buy. And you might ask, why would anyone pay for something that's currently worthless?
Hope.
Hope is the perfect word for it. They still have time value. As long as there is time left before the option expires, there's a chance that the price might shoot up and make it profitable. You're paying for that chance.
So an option's total price, the premium, is made up of its intrinsic value plus its time value.
You've got it. An OTM option is 100% time value. An ITM option is a mix of both intrinsic value and time value.
Got it. Okay, moving to the fourth and final product, swaps, section 10.3.4.
Swaps are exactly what they sound like. An agreement between two parties to exchange or swap cash flows on a future date. The most common types are interest rate swaps and currency swaps.
The text gives a pretty good interest rate swap example. Let's break that down because corporate finance can get a little dry sometimes.
Okay, so meet party A. She's a corporate borrower. She has taken a big loan from a bank that has a floating interest rate. The text defines this as T-bill rate plus spread.
Okay, so if the Treasury bill rates go up, her loan payment goes up every month. She's stressed about that.
Right.
She wants certainty in her budget.
Right. She fears that the RBI is going to raise rates, and that will crush her company's profits. She wants a fixed rate. So she enters into a swap agreement with a dealer, which is usually a big bank.
And what does that agreement look like?
In this agreement, two things happen. One, she agrees to pay a fixed rate payment to the dealer every month. Two, in return, the dealer agrees to pay T-bill plus spread, the floating rate, to her.
Ah, I see what happened. She effectively handed off her floating bill to the dealer. She pays the dealer a nice, predictable, fixed amount.
Right.
The dealer gives her the unpredictable floating amount. She takes that floating amount and immediately hands it over to her original loan provider. The two floating payments cancel each other out.
Exactly. The floating receipts cancel out her floating loan payments. She has effectively converted her floating loan into a fixed-rate obligation. She has swapped her risk. The dealer takes on that risk, usually because they have an opposite need somewhere else in their massive book of business.
That's very clever. Now, swaps aren't traded on the stock exchange like the NSE, are they?
No, they are over-the-counter, OTC, but they are highly regulated. In India, the governing body for this is FIMDA. Flag that name for the exam.
FIMDA, that's the Fixed Income Money Market and Derivatives Association of India. What exactly do they do?
The text lists 8 specific objectives. You should be able to recognize these for the exam. Basically, they are the self-governing body for the bond and derivatives markets.
Let's go through the list.
Okay. 1, they are the principal interface with regulators like the RBI and SEBI. 2, they handle developmental activities like creating benchmark rates. 3, they train dealers and support staff. 4, they adopt international standard practices to keep our markets modern.
So they set the rules of the game.
Exactly. 5, they devise best market practices. 6, they can act as an arbitrator for disputes between members. 7, they create standardized documentation so lawyers don't have to write a brand new 1,000-page contract every single time. And 8, they facilitate the smooth functioning of the market.
So basically, FIMDA sets the rules, settles the fights, and talks to the government on behalf of the swap market.
That's the perfect colloquial summary, yes.
Okay, section 10.4, structure of derivative markets. We've kind of touched on this already, but let's formalize it.
The text divides the market into 2 very simple structures, OTC and exchange traded.
These are the non-standard, privately negotiated deals. Think of a street bazaar where you haggle directly with the shopkeeper.
So forwards and swaps fall into this category.
Correct. The key feature is that the counterparties know each other. Then you have exchange-traded markets. These are standardized contracts settled through a central clearinghouse. Think of a supermarket with fixed prices and products.
And that's where we find futures and options.
Yes. And the key feature here is that it's anonymous. The buyer and seller have no idea who is on the other side of their trade. They only know they are dealing with the exchange.
Simple enough. Section 10.5. Purpose of derivatives. Why do we even have these things? What's the point?
The text boils it down to three main uses: hedging, speculation, and arbitrage.
Hedging is basically like buying insurance, right?
That's the best way to think of it. A hedger is an investor who already has an asset and the risk that comes with it. They use derivatives to reduce or eliminate that risk, like our wheat farmer selling futures. He isn't trying to make a killing. He's trying to guarantee he can pay his bills at the end of the season.
Okay, so that's risk reduction. What about speculation?
A speculator is the opposite. A speculator has no underlying asset. They have no wheat to sell. They are simply betting on the future price direction using derivatives. They are taking on leveraged risk in the hopes of making a profit.
They provide the liquidity that the hedgers need.
They do. They take the other side of the hedger's trade.
And arbitrage, this is the fun one, free money.
Well, theoretically risk-free money. Arbitrage relies on a core economic principle called the law of one price. It says that identical goods cannot trade at different prices in different markets efficiently for very long.
Can you give an example?
If gold is selling for Rs 50,000 in Mumbai and at the exact same moment Rs 50,100 in Delhi, and assuming transport is free and instant, an arbitrager would buy it in Mumbai and sell it in Delhi for a riskless profit of Rs 100.
And by doing that, by adding buying pressure in Mumbai, which pushes the price up, and selling pressure in Delhi, which pushes the price down, they force the two prices to meet in the middle.
Exactly. Arbitrageurs are like the market's policemen. They enforce pricing efficiency.
Section 10.6. Benefits, costs, and risks. We've talked about some of the benefits like risk management and price discovery. What about the big risks?
The single biggest risk, and the one that gets people into trouble, is leverage risk.
How so?
Because you only have to put down a small margin, say 10% of the total contract value. You are controlling a huge position with very little capital. This is great if you're right. A 5% move in the stock price could mean a 50% return on your margin.
But it cuts both ways.
It cuts both ways, hard. That same 5% move against you could wipe out half your capital. A 10% move against you and you've lost 100% of your money. It's a double-edged sword.
The text mentions a specific document here that brokers have to give clients. This sounds like another exam flag.
This is a huge exam flag. It's called a model risk disclosure document. This document must be given by the broker to the client before they are allowed to start trading derivatives.
And what does it say?
It basically says that trading in derivatives is extremely risky and not suitable for everyone. It highlights that if you have limited financial resources, low risk tolerance, or don't understand the products, you should not be participating. It's the warning, cigarettes cause cancer label of the finance world.
A legal requirement to cover the broker.
And to protect the investor from themselves.
Okay, section 10.7. Equity, currency, and commodity derivatives. The concept is the same, just the underlying changes, right?
Exactly. Let's touch on commodities first. Commodity derivatives allow for risk protection all along the value chain. Farmers, processors, traders, end users.
The text gives a biscuit manufacturer example.
A great one. A biscuit manufacturer needs a huge amount of wheat to make their biscuits. They are worried the price of wheat will skyrocket in the next few months, which would destroy their profit margins.
So they hedge.
Right. They buy wheat futures today to lock in the price for delivery later. They are hedging against input cost inflation. And for these contracts, the parameters are very explicit. Quality of the wheat, quantity, the exact delivery date, and even the warehouse location.
Which exchanges handle these commodity trades in India? This sounds like an exam question.
It is. You should be able to list these exchanges. MCX, the Multi-Commodity Exchange, NCDX, ICEX, NSE, and BSE.
And the commodities are grouped.
Yes, into four main buckets. Bullion, which is gold and silver, metals like copper and zinc, energy like crude oil and natural gas, and agriculture, which covers everything from cardamom and cotton to mentha oil.
And currency derivatives, what's the underlying there?
Here, the underlying is the exchange rate between two currencies. We trade in currency pairs, so you're essentially betting on, say, the US dollar getting stronger or weaker against the Indian rupee.
What are the main pairs available in India? Another exam flag.
Definitely. The four main pairs are USD INR, UR INR, GBP INR, and JPY INR.
Can I trade, say, the euro against the US dollar directly?
Yes, those are called cross-currency pairs, and they are also available. The main ones are EUR USD, GBP USD, and USD JPY.
All right, we are in the home stretch. Section 10.8, Derivative Markets, Products, and Strategies. This section has some math. Let's tackle the pricing of futures contract using the cost of carry model. This is where people's eyes tend to glaze over.
Okay, listeners, let's visualize this formula. It's actually very simple and intuitive once you get it. The formula is $5 is S plus C.
Okay, F equals S plus C. What do the letters stand for?
$5 is the futures price. $0 is the spot price, the price of the asset right now. And $1 is the cost of carry.
What on earth is cost of carry?
It's the cost involved in holding the physical asset until the future date. The biggest component is interest. Think about it this way. If you buy stock in the spot market for Rs100, you have to pay Rs100 cash right now. That cash leaves your bank account. You lose the interest you could have earned on that 100 rupees.
Okay, opportunity cost.
Exactly. But if you buy a future, you don't pay the Rs100 now. You just pay a small margin. You get to keep the rest of your money in the bank, earning interest. Therefore, the person selling you the future is going to charge you for that interest benefit you're getting. That charge is the cost of carry.
Can you walk us through the simple example from the text?
Sure. Let's say the spot price is $100, and the interest you would lose over the next 20 days, the cost of carry, is 20. Therefore, the fair futures price should be 100 plus 20, which is 120.
Okay, so the future should almost always be more expensive than the spot because of this interest component.
Usually, yes. And the difference between the spot and the future price is called the basis. Now, here's the concept of convergence. On the settlement date, on expiry day, the time remaining is 0. So the cost of carry becomes 0.
Which means F must equal S.
On expiry, spot price must equal futures price. They have to converge to the same number.
And if they don't?
Then there is free money lying on the table, and the arbitrageurs, who we talked about, will attack it until the prices are forced back in line.
This leads us to the spot future arbitrage calculation. The text details a very specific numerical example. I think we should walk through it step by step because they might change the numbers on the exam, but the logic will be identical.
Let's do it. So the setup. The date is March 3rd, 2017. The expiry date of the future is March 30th, so that's 27 days to expiry.
Okay.
Now here's the opportunity. You can buy stock XYZ in the cash market, the spot market, for Rs 3,984. At the same time, you can sell the March XYZ futures contract for Rs 4,032.
Okay, so the future is trading at a premium to the spot. It's more expensive.
Right. The difference is Rs 48. 4032 minus 3984. So the arbitrager performs two trades simultaneously. They buy the spot at 39.84 and sell the future at 40.32.
So they are long the stock and short the future.
Exactly. Because they know the prices must converge on expiry, they have effectively locked in that RS48 profit, regardless of where the market goes. If the stock goes to 5,000 or 3,000, it doesn't matter. The difference will be 48 rupees.
So how do we calculate the annual return on that?
The formula for the return is profit investment multiplied by 365 days to expiry.
Okay, so plug in the numbers.
The return equals 3,984 times 365.27.
Why do we multiply by 365 divided by 27?
That's to annualize the return. You made a certain percentage in 27 days. We want to know what that would look like if you could repeat that trade for a whole year.
Got it. And what does the math work out to?
The calculation yields 16.287% per annum.
16% risk-free. That's an amazing return.
Which is why these opportunities rarely last long. In the real world, high-frequency trading algorithms and bots usually find and eliminate these discrepancies in milliseconds. But for the exam, you need to know how to do that calculation.
Okay. Finally, let's wrap up with option payouts. We talked about them being asymmetric. What does that mean in terms of profit and loss?
This is the final conceptual hurdle, and it's a big one. Let's look at the long side first, the buyer of an option. You pay the premium up front. Let's say it's 10 rupees. That is your maximum possible loss. If the market goes against you, you lose 10 rupees, and that's it. You can't lose more.
So limited downside.
Limited downside. But your potential profit is theoretically unlimited. If you bought a call option and the stock goes to the moon, your profit keeps increasing. So limited downside, unlimited upside.
What about the seller? the person who wrote the option.
It's the complete opposite. The short on an option, the seller. You receive the premium. That 10 rupees is your maximum possible profit. You can never make more than that initial credit you got on day one.
Limited upside.
Limited upside, but your potential loss is theoretically unlimited. If you sold a call and the stock skyrockets, you are on the hook to deliver those shares, and your losses can be massive. So for the seller, limited upside, unlimited downside.
Why would anyone sell options then? It sounds like a terrible deal, picking up pennies in front of a steamroller.
It can be, but they do it because the probability of winning is often higher, even if the payoff is riskier. Most options expire worthless. So it's like being the casino. The casino can lose $1 million on a single jackpot, but most of the time they just quietly collect all the small bets from people who lose.
One final exam flag here from the text regarding assignment risk.
Yes, very important distinction. For American options, assignment, which is being forced to fulfill the contract by the buyer, can happen any time before expiry. For European options, which is what we mostly have in the Indian index and stock markets, assignment can happen only on the expiry date.
Phew. Okay. That was comprehensive. I think my brain is full.
We did cover it all. The acts, the definitions, the 4 main products, the risks, and the math.
So, to summarize the application for our listener who's getting ready for this exam, derivatives are tools for risk transfer. You can use them to hedge and protect a portfolio, or you can use them to speculate, but they are leveraged, so you have to handle them with extreme care.
Exactly. And I'll leave you with a final thought on that idea of efficiency. We talked about arbitrage, that so-called risk-free profit.
Yeah.
If you ever see a price gap in the market, like the one in our calculation, ask yourself, why is it there? In a truly efficient market, free lunches shouldn't exist. The market is essentially a global, real-time race to find these tiny price gaps and close them before anyone else can. When you look at a screen of flashing numbers, you aren't just looking at prices. You are looking at the collective agreement of millions of people on the value of everything, all at once.
That is a deep thought to end on. Next time you see a future price that's higher than a spot price, you'll be able to visualize that cost of carry.
And you'll know why it's there. Good luck on the exam. After this, you're going to crush this section.
Thanks for listening to The Deep Dive. We'll see you next time.